Okay, so this is the entry just to record the deferred income tax expense related to the taxable temporary differences. We still have deductible temporary differences that we had this year, and we have to consider the future impact of those. So the book just handles it in two different steps. You know, it's really, honestly, most of the time it's fine to just look at all the temporary differences together in one schedule like this and just list them all out, you know, and then just handle them in one lump sum. And that usually works. There is a reason why they keep them separate. Um, um, we'll get to that in a little bit. Let's see. There's a what if scenario. Okay, so this what if scenario is showing you just what happens if the expected future tax rate changes from 34% to 35%. What do you do in that case? And what you do is you simply, this is the same schedule that we had right up here. You simply multiply the ending cumulative temporary difference by 35% instead of 34%. That 1% difference is handled by subtracting your ending deferred tax liability from the beginning. So you can see that your entry to record your deferred tax expense is bigger than it was before because you're expecting to pay more tax in the future because the tax rates went up. This example now gets at the deductible temporary differences. So before we dealt with the taxable ones, the ones that are going to result in deferred tax liabilities in the future. This one relates to deductible temporary differences. These were amounts that increased our taxable income this year, but will cause future deductions for us. So kind of like good guys. Same idea here, same exact headings as we had before for accumulated depreciation. Coming into this year, we had all of these cumulative timing differences. These were amounts where in the past these amounts had added to taxable income. They were unfavorable at that time, but they were going to cause future deductible amounts. Okay, so these amounts were all coming into this year. They get tax affected, and we can see that $679,000 has previously been recorded as a deferred tax benefit, okay, coming into this year. Now we have to add our current year changes. These are all the timing differences from the current year, and we just have to add these in to what was there at the beginning of the year to get an ending at the end of the year, cumulative timing differences, and then we tax affect those at 34%. So now we end up with this beginning of the year deferred tax asset, this end of the year deferred tax asset, and the difference, the change, represents the deferred income tax benefit that we have to recognize this year. We're going to pay less tax in the future because of these items, and that's a benefit to us. So we increase deferred tax assets, and we increase our deferred income tax benefit. And this is showing you what the increase in tax rate would do. If you had a 35% rate in the future, it's the same idea. The ending cumulative temporary differences would just be tax affected by 35%, and you'd have a bigger journal entry right here. Now, I think we're going to look at the netting of these two things. Remember, but if I go back up to the deferred tax liability entry, here we've got deferred tax liability that we recorded for accumulated depreciation and deferred tax expense. And down here we've got deferred income tax benefits. So these are kind of like opposites. They would be netted down into one cumulative deferred income tax expense or benefit that gets recorded on the income statement. And eventually the deferred tax liability and asset will get netted too and be typically recorded as one net deferred tax liability or deferred tax asset on the balance sheet.